Audio check, video check, take. In session 8, managerial accounting, we are going to use these formulas. The first one is a very simple one and kind of obvious. It says that profit equals revenues minus costs, and costs are divided into fixed costs and variable costs. So profits equal revenues minus fixed costs minus variable costs. The second one is the formula for variable contribution margin, and variable contribution margin is defined as revenues minus variable costs. Now, why has fixed cost been left out of this equation? It is because fixed cost does not change as you vary the amount of production, and so this gives you an idea how the revenues minus costs change as the amount of production is varied. Now, if revenues minus variable costs, now if you take fixed cost to this side of this equation, then revenues minus variable costs become equal to profit minus fixed costs. So the variable contribution margin also equals profit minus fixed costs. The next equation is for the variable contribution margin ratio, and this is found simply by dividing the variable contribution margin by revenues. So it is revenues minus variable costs, which give you the variable contribution margin divided by revenues, and that gives you the variable contribution margin ratio. We now come to the managerial accounting part of the course, and we start by looking at costs. Now here are some meaning of various cost functions, various cost terms. The first distinction of costs, and a very important one, is between variable costs and fixed costs. So variable costs are costs associated with, let's say, raw materials or amount of labor needed to manufacture some good. Basically costs which are proportional to output. And sometimes labor will be proportional, and sometimes you have a fixed number of employees, in which case it won't be proportional. Now, variable cost per unit is constant, which is to say you divide variable cost by the number of units being produced, and that should be a constant. Fixed costs, on the other hand, are costs such as rent or some, let's say, equipment, which property, plant and equipment, which are not going to vary with the level of production. So fixed costs are fixed, which means that if you produce more of the output, fixed cost per unit will keep falling. So fixed costs per unit varies inversely with output. So that's the first important distinction for costs between fixed costs and variable costs. And now we come to some other kinds of costs. The first one is a sunk cost. A sunk cost is a cost that has been incurred in the past. So when you're making a decision whether you do something or you don't, if the cost is in the past, then it's not going to be affected by your decision. In which case, that cost should have no bearing on your decision. Because whether you do a project or you don't do a project, that sunk cost is gone. So that is not relevant to the decision of whether to do a project. So sunk cost should not be considered in current decision making. And opportunity cost is the value that could be earned by an asset or a resource in an alternate use. The most common kind of example of an opportunity cost is, let's say you think of doing a project, you, like, let's say, start up some farm, then you could be earning money if you spend your time elsewhere. I mean, if you spend your time working instead. So let's say if your salary per year is $100,000 and you're giving that up by working on your own startup instead, then you would say that the opportunity cost for your working on that startup is $100,000. So it is not a cost which you're actually paying anyone, but it is a cost because your alternate use for your time would have generated $100,000 which you're giving up. Direct costs are costs which can be directly traceable to some cost object. Indirect costs cannot be easily traced to some cost object. For example, a direct cost could be the steel which a car manufacturer uses to manufacture a car. So it's a direct cost. Whereas the public relations department of a farm, you can't really say that you can't directly trace the cost of that. Controllable costs can be controlled by a specific manager, and if the manager does not have control over some costs, then they're called non-controllable costs. For example, the price of, again, steel, let's say, for a car manufacturer, it's not the manager cannot control that cost. That cost is determined by market conditions, international market conditions. Whereas direct costs could be, let's say, administrative costs. The manager can decide, okay, we are in a bad situation, we need to cut costs, so they may say that, okay, we're going to work with 2 administrative assistants instead of 3. Here are 2 important managerial accounting ideas. So here is the first example for costs, and here we have an example of sunk costs. You have bought tickets to a movie that has cost you $15 to purchase the ticket, and you can return the ticket to the theater for the purchase price minus a $5 restocking fee. So on the day of the show, you think of going for a dinner instead, which will cost you $30. And the question is, what is your sunk cost with respect to the ticket? Now you paid $15 already, and is $15 a sunk cost? Well, actually no. $15 is not a sunk cost because you can retrieve part of it. The sunk cost part of it is only the part that you cannot retrieve. And what is the part of that purchase price of the ticket that you cannot get back? And that is $5. So your sunk cost will therefore be only equal to $5. Here we have an example of incremental analysis. Jack has taken a year off from college and has 2 options. He can either work and he doesn't have his degree still, so he's not going to earn a lot. He's going to get about $20,000. And instead, he could go to Europe and spend the year there, and that's going to cost him $25,000. So the question is, what is the incremental cash flow for A over B? Like if we chose A instead of B, and is it $20,000 which he would earn, or is it like the $25,000 which he'll have to pay? It's actually the sum of these two. because the incremental analysis is looking at the difference between the two options. So here is minus 25 and here he is plus 20. So the answer would be 45,000. Here we have an example of a firm, and we are going to calculate the opportunity cost of not working. So it provides landscaping services from January to November, and the owner takes December off. He just likes to have a year-end vacation. And so the question is that, what is the opportunity cost of not working in December? So the owner, let's say, by not working in December, he is doing something and he's not having to pay anybody. But however, the firm is not working, the firm is not operational. So the question is that, what is the opportunity cost of having the firm not operational? So what is the alternative use for the firm? The alternative use for the firm is to have it operational. Okay? And if the firm did operate, then it would earn the monthly profit, and monthly revenues are 50,000, expenses are 20,000 for labor and 8,000 for leased equipment. So during a month, this firm generates 22,000 in profits. Now, if it generates 22,000 profits, if the owner chooses the option of not keeping the firm operating, then he's giving up 22,000 for that month of December. And that is the opportunity cost. So the answer for opportunity cost is 22,000. And that is basically the profit which the firm makes in a month. Here we have a firm which makes shirts for boutique stores. And its production costs for 10,000 shirts are cloth 50,000, labor 100,000, rent 20,000, and advertising 70,000. And it's also given that the cloth and labor costs are variable, whereas rent and advertising are fixed. The first part of the question asks that if production increases to 15,000 from the current 10,000, estimate the cost of one shirt, for producing one shirt. And to answer that question, look at the variable cost, because only the variable cost will increase. So the number of units has gone up by 50%, so the variable cost will go up by 50%, whereas the fixed cost will remain the same. So cloth will increase from 50K to 75K. Labor will increase from 100K to 150,000. Rent is going to remain at 20, and advertising is going to remain at 70. And so the total cost is going to be 225 plus 90 is 315. And then to find the cost per shirt, we are going to divide by the number of shirts being produced. So that will be 315 divided by 15K. So 315,000 divided by 15,000, or that is going to be 21. So the cost of producing one shirt is going to be $21. That's the total cost of 315 divided by the number of units being produced, which is 15K. The second part asks, if labor costs $20 per hour, what is the number of labor hours needed to produce one shirt? And for that, you look at the labor cost. So it's 100,000 when there were 10,000 shirts being produced. And of course, the labor cost per shirt will not change as we increase production from 10,000 to 15,000. So let's calculate it using the level of production of 10,000 shirts. So if 10,000 shirts require $100,000 of labor, and each labor is $20 per hour, then the number of hours would be 100 divided by 20, or the number of hours would be 5,000. So 100,000 divided by 20 is 5,000. So if 5,000 labor hours are required to produce 10,000 shirts, then the number of labor hours required per shirt is 5,000 by 10,000, which is half an hour per shirt. This is 5,000 hours. And that is found, the number of hours is found by dividing 100K. And I remind you that the letter K stands for kilo, which is 1,000. So instead of writing 100,000, you just write 100K. And I'm dividing that by the number of hours, the number of dollars paid to labor per hour. So that would be 100,000 divided by 20. So that will give you 5,000. So 5,000 is the total number of labor hours being spent to produce 10,000 shirts. So each shirt needs half an hour. Continuing with the previous question, we do incremental analysis. And the question is, if increasing production from 10,000 to 15,000 drops the price from $50 to $40, then should Trendy increase production? And you remember that the variable costs for cloth were 50,000 and for labor was 100,000, and those were the variable costs. So those are the ones which increased. And the variable cost for cloth went from 50,000 to 75,000 because it was a 50% increase in the level of production. So the extra amount that Trendy would have to pay for cloth was 25,000. The extra amount you would have to pay for labor would be 50% of 100,000, which would be 50,000. So the extra amount of variable costs would be 75,000. What about revenues? Well, you're going to compare this with revenues. And just look, this is the entire increase in cost, because fixed costs don't increase. Because that's what the definition of fixed cost is. They are costs which do not increase as you vary level of production. So this is the entire increase in cost. As for increase in revenues, before it was selling 10,000 shirts at $50 each. Now it will sell So this was the previous revenue, which was 500,000, 500,000. This is the new revenue, which is 15,000 into 40, so that's 600,000. So what is the increase in revenue? Well, the increase in revenue is 600,000 minus 500,000, which is 100,000. So revenues have gone up by 100,000. Costs have increased by 75,000. And incremental analysis tells you this is a good thing to do. So Trendy should indeed increase production.